Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, margin of safety, Buffett's secret weapon.
Yeah, this is probably the most important concept in investing, honestly.
I mean, we're talking about the ultimate financial shield, right? So if you're listening today, our core mission is to unpack this buffer against disaster. It's basically the whole foundation of value investing.
It really is.
Yeah.
And, to understand what it is, you kind of have to look at its origin story. The term was actually coined by Benjamin Graham and David Dodd.
Right, back in the 30s, yeah.
Exactly, in their 1934 book, Security Analysis, and then Graham really expanded on it later in his classic, The Intelligent Investor.
Yeah.
But, the core definition is surprisingly simple.
Which is nice for a change in finance, right?
Right, yeah. It's literally just the difference between a stock's intrinsic value, like what the company is actually worth, and its current market price. That gap is your margin of safety.
So to ground this for you listening, I actually like to think about it like going to the airport.
Oh, yeah, the flight analogy.
Yeah.
Right. So say your flight board's at 5 p.m. You don't aim to pull up to the terminal at exactly 4.55. You leave early. You aim to get there by maybe 3.3 or 4.0.
Because things go wrong.
Exactly.
Yeah.
You don't plan on hitting a massive traffic jam or, having the security line wrap around the building, but you build in that extra hour anyway. That extra time as your margin of safety gets missing the plane.
That's a perfect way to look at it. And, translating that to stocks, this is exactly why the CFA Institute looks at investing fundamentally as managing risk and uncertainty.
Because you can never know for sure what's coming, right?
Right. You just can't predict every variable.
Yeah.
And Investopedia actually makes a great point about this, too. They know this buffer is incredibly critical during market volatility.
Oh, totally. When everyone else is panicking over every little price drop.
Exactly. It keeps you focused on your long-term goals. If you bought with a huge margin of safety, you don't care about, some unpredictable short-term price fluctuation, you're protected.
Okay, but here's the thing. Leaving an hour early for the airport is really easy to calculate. But how do we mathematically calculate this buffer for a company?
Oh, well, that requires a bit more legwork, yeah.
Because you have to figure out what the company is actually worth first, right?
Before you can even find your margin of safety, you have to estimate that intrinsic value.
And how do we actually do that?
So, according to Benjamin Graham, you have to really look under the hood. You're analyzing their financial statements, looking at the management team, studying industry trends, and figuring out their competitive position.
But wait, let me push back on that for a second. Isn't intrinsic value basically just an educated guess? No one can perfectly predict future growth or exactly where an industry is headed in 5 years.
You're 100% right. It is a guess, but that's exactly why the margin of safety is so crucial.
Oh, because your guess might be wrong.
Yes. Warren Buffett actually has this famous analogy for this. He talks about driving a heavy truck across a bridge.
Okay, I love a good Buffett analogy.
Right. So when structural engineers build a bridge, they don't build it to hold exactly the maximum weight of the cars they expect. If they think a 10-ton truck is going to cross it, they build a bridge that can hold 30 tons.
Okay, I see. That extra 20 tons of capacity protects against the unexpected, like an unusually heavy load or, materials degrading over time.
Exactly. It's the exact same math with stocks.
So let's actually walk through that math for the listener, because the formula is pretty conversational once you break it down. It's just intrinsic value minus market price, right?
Yep, that's a raw dollar amount.
Wow.
Or if you want it as a percentage, which is how most people use it, it's the intrinsic value minus market price, and then you divide that by the intrinsic value.
Okay, so let's use some real numbers to make it concrete. Let's say we do all our Graham-style analysis.
All heavy lifting.
Right. And we calculate that a stock's intrinsic value is exactly $100. But we look at our brokerage app, and the market price is currently trading at $80.
So your margin of safety there is $20.
Right. And to translate that to a percentage for you listening, that means you have a 20% margin of safety. You're basically buying the stock at a 20% discount to what it's truly worth.
Exactly. And that 20% is your shock absorber if your $100 estimate was a little too optimistic.
Okay. So if the math is literally that simple, just buying things on sale, it seems like everyone should be a billionaire by now.
You would think so, right?
So what are the traps? Like, where do investors mess this up when they try to apply this formula?
Well, the biggest pitfall, by far, is overestimating that intrinsic value. It's the rose-colored glasses effect.
Oh, Like when you really want to buy a stock because you like the company, so you kind of force the math to work.
Exactly. Investors get overly optimistic about a company's growth, or they just totally ignore the potential risks. They basically tell themselves the bridge is stronger than it actually is.
So how do you stop yourself from doing that? Because we all have biases.
Well, the CFA Institute actually has a great solution for this. They warn investors to be extremely cautious and to use what they call sensitivity analyses.
Meaning you test different scenarios.
Right. You can't just run your numbers assuming everything goes perfectly. You have to run a worst case scenario. Like, what if a competitor steals their market share? What if interest rates spike?
So you're finding the intrinsic value even if things go wrong.
Yep. You use multiple scenarios.
But wait, if we do that, if we demand a massive stress-tested margin of safety on every single stock, don't we risk missing out on buying truly great high-quality companies?
What do you mean?
I mean, incredible businesses with huge competitive advantages rarely go on sale, right?
Yeah.
If I'm demanding a huge discount, I'm just going to be sitting on the sidelines forever.
Okay. I'm glad you brought that up because you're touching on a massive misconception, and that's the idea that the margin of safety is a one-size-fits-all number.
It's not a fixed percentage.
No, not at all. The required buffer actually changes based on the risk profile of the specific company.
Oh, interesting. So it's more like a sliding scale.
Exactly. So as a general rule of thumb, let's say you're looking at a super high quality stock. Like they have incredibly strong, predictable financials and a massive competitive moat.
Like a major blue chip tech stock or a utility company?
Right. For those, you might only need a really small margin of safety. You might be willing to pay, say, up to 90% of its intrinsic value.
So just a 10% margin of safety.
Yep. Because the risk of a catastrophic surprise is so low. But on the flip side, what if you're looking at a highly speculative biotech company?
Right, where they have no earnings and their whole future depends on one FDA trial.
Exactly. For a risky stock like that, a 10% buffer is useless. You need a massive margin of safety.
Because the downside is basically zero.
Exactly. So for that one, you might demand paying only 50% of the intrinsic value. You need a huge discount to account for the heightened risk of things just completely falling apart.
Okay, that makes perfect sense. It's like a dial that you adjust based on the quality of the company you're analyzing.
Exactly, yeah.
So let's do a rapid recap for the listener just to lock in these core pillars for your own investing toolkit. First, the margin of safety is simply the physical gap between intrinsic value and market price.
Right. And second, calculating it means you have to actually roll up your sleeves. You're analyzing financials, competitive advantages, and the management team.
And third, the percentage you demand isn't fixed. It scales with the risk of the stock. You might accept a 10% margin for a high-quality blue chip, but demand a 50% margin for a speculative startup.
Spot on. And, if you really want to master this, there are two resources you absolutely have to read.
The Graham books, right?
Yep. The foundational text is Benjamin Graham's Security Analysis. It's dense, but it's the Bible of value investing. And for a more accessible read, pick up his later book, The Intelligent Investor.
Those are absolute must-reads. But before we wrap up today, I know you wanted to leave the listener with a final thought to mull over.
Yeah, just something a bit provocative to chew on. So we've established that calculating intrinsic value requires making all these assumptions about future industry trends and management performance, right?
Yeah, right, which are ultimately guesses.
Exactly. So the question is your margin of safety ultimately only as safe as your own ability to predict the future?
Oof. That's a little uncomfortable to think about, but a fantastic question.
It really makes you second guess your own biases, doesn't it?
It does. It
Yeah.
absolutely does. That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.